stocks didn't start so well the week here in the morning, but it had about as good of a finish as it could have considering the way that we gapped down to the upside. Yields continue to be the dominant story. Yields just march higher. They just continue. The 10-year yield continues to move higher up to 4.8%. Again, remember the Fed funds overnight rates at 4.25%, 4.5%. So we're well outside of that range. And we're still moving. And today, at least for the last so many days, crude oil has really taken off as kind of a reflection that commodity prices are rising. So like the worst thing that can happen is that a lot of this rising going on in yields is due to higher inflation expectations. And considering the jump in commodities, as you'll see here in a minute, that seems to be the case, that inflation expectations are rising. We'll take a look at some of the charts to see, like, are we in an intermediate decline? It just seems like we're on the cusp of one, but we don't actually ever take the plunge. There are some indicators that suggest maybe we have, and I'll show you those. There are some indicators that suggest that we have so much that we might actually be done, which actually might be a really good thing considering how much we've declined already in some of the other broader indexes like the Russell 2000. So we'll break all that down. What's driving the price action, and what we expect to see going forward if a lot of what's driving starts to reverse course, especially considering how parabolic some of these asset classes are moving. So we'll break all that down in today's trade ideas. One of the Mag 7 companies that's obviously in its own bearish pattern right now, but might be finding some very significant support. I'll show you what that is and where that support's at and why it's significant and how to trade it. So let's go ahead and get started. Today is Monday, January the 13th, 2025. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. So I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. We do this every day, whether there's a Market Outlook video or not. We do this every day at 3:30 Eastern time. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon, which is usually there. Or just click on this image. It opens up this tab. Hit that like button again. The more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do this day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we got the dark pink shading and a red line. We're still like just flirting with that 2.5% mark. We got just a smidgen below it on Friday, 2.73. We're back up to 2.48 right now. So we're actually still kind of holding the line pretty well. The short-term sentiments never has been significantly bearish except for right at the very start of this whole decline back on the 18th of December. So almost a month ago now. In fact, the short-term sentiment actually turned up a little bit today. And remember, the intermediate line or near-term line crossing above the intermediate line is actually going to be a bullish thing. So that could very well happen here early, like tomorrow, Wednesday. At least that's what you'd expect, right? Considering the short-term lines and their nature to oscillate quickly. And again, once the near-term line crosses 40, we're watching to see where's that momentum line, how likely is it to be on the second day up above 80, those kind of, how likely we're going to get a bullish near-term run out of this. But as of right now, this is the extent of our intermediate decline. I saw something about the CNN Fear and Greed Index being at extreme fear levels. Like we're not even down, like we're barely down more than 4% right now. There's no reason, and we're still like over 12% gain off of this low point, even though we're not 17.5% anymore, but we're still over 12. That's still a pretty good return. Like that, we are hardly in extreme fear conditions. If anything, we might be in neutral conditions, right? We're definitely not in greed right now, but we're not in fear either, like hardly at all. This is still just a very minimal pullback, that we're getting. The market sentiment line's falling, but again, it's still in bullish territory. So again, intermediate line cross above, that would be bullish and start us off on a new intermediate rally, kind of like what we saw in the beginning of the last intermediate rally that we had. Let's take a look at the NASDAQ 100, which is driving most of this strength in the S&P. It's now, for the first day, has dark pink shading and a red line. So this is the first time the NASDAQ 100 has been in bearish territory. Again, does not have bearish short-term sentiment. I mean, it is bearish, but it's not extreme. And so it can pop really easily off of this. If you look at the other kind of more broader indexes, the Dow Jones Industrial Average had a good day today thanks to United Health, but it's still clearly dark pink shading and a red line. Its intermediate lines down in the reversal zone. Short-term sentiments also improved and never really did get to significant lows here on the second, aside from the first drop that we had right there. And then finally your Russell 2000. Again, dark pink shading and a red. I mean, clearly intermediate decline there. Much different situation here than what we see on the NASDAQ 100. Intermediate line again in the reversal zone. Short-term sentiment, though, did not get strongly bearish and it's pointed slightly higher here. So again, the expectation is over the next few days that the short-term sentiment should pop, right? And again, this may be the extent of the intermediate decline on the S&P 500, and that would be a very, very nice thing here if this is pretty much all we had. I mean, the last two intermediate declines weren't very much either, right? I mean, 5% there. It was 5% except for this day. Like right here, we were right around 5%, and then we had that kind of odd day there coming out of the weekend. But then, of course, it didn't last because we just rallied immediately. So that probably should have been a 5% move. And then now 5%, not even a 5% move here. Now the NASDAQ 100 did get to the 5%, but there's a good chance like we can really rebound off this. It depends on what kind of near-term bounce we get. As this is clearly a bearish near-term low, being in the bearish territory and being slightly lower, ever so slightly lower than the last two previous lows. If you look at the weekly chart, you can see it's clearly bearish after getting the red arrow on the transition candle last week. This is probably, this is the biggest bearish candle we've had so far. It's been bearish all 5 weeks. Remember, these are Hakinyashi candles, not regular candles. And again, this is about the extent of the size of the candle that we got on the first intermediate decline of 2024. Obviously got a little bit bigger, but before that, August 5th, this is what it looked like, and again, about the same extent as where we are right now. If you look at the Dow Jones Industrial Average, it's a little different. We've been a little bit more bearish. PPO is moving down a little bit more significantly, and then you look at the Russell 2000. Oops, if I can type right here. And the Russell 2000 is actually flirting with its 40. The Hakinyashi close, as of right now, is flirting with the 40-week exponential moving average. So, a much different scenario in terms of bearishness for the Russell 2000 than what we're seeing on the mega cap influence large cap indexes. Obviously, if you look at the 3 green arrows charts, we have 3 red arrows and a red line now on the Russell 2000 on the NASDAQ 100, but we have it on the S&P. We've had 3 red arrows, on the Dow and the Russell. So we've been in this bearish decline for a while now. Looking at the 2-line version of the S&P 500, we are there below the 8 and 17. Have now crossed the 50 as well. We're clearly between the 50 and 200. We're kind of in this gray box right now. This gray box is based off of a head and shoulders pattern with a shoulder there, a head here, and another shoulder. So the bottom of the box would be the target if we were to, fulfill what the pattern says we will. And that's a little bit above the 200-day moving average as it stands. MACD is negative below its moving average. Stochastics is still in bearish territory, but still not in the oversold levels. So that's a good sign for the stochastics. Looking at the DMI well above 30. In fact, the ADX is above 30 on this. Even though, again, we're not down 5%. I mean, it's pretty rare for the ADX to be this strongly bearish and not be down 5%. It's insane just how bearish. Again, looking at IWM as the alternative, and you can see it's actually more bearish, and yet its ADX is barely crossing 25. So you can kind of see a different story there. It has a lot to do with, the kind of drop we're getting, on the S&P, where it's just fueled by just a few stocks. Your RSI is still bearish, right? This is, again, a kind of a longer bearish pattern that we've had, this red box, about as long as what we saw over here. Remember, to get green, it's got to cross 50 and then confirm it by getting above 60. We are back below minus 150. When you look at the weekly version of this, we are flirting with minus 100. So this can be a seminal week, right? If we cross that minus 100 this week, if we get down to the lows, then we could have something similar to what we saw in 2022 when we crossed below minus 100. And the same thing here in the fall of 2023 when we briefly crossed below the minus 100 level as well. Again, on the weekly CCI. Looking at the Ichimoku cloud, we are now below the cloud. The cloud still has not turned pink, however. The rate of change is clearly negative, but we don't even have a bearish trend. It's not even weak. There is no trend right now according to this. Now, if I look at IWM, there is a mature bearish trend. We are below minus 5. We're above 80. So we have a mature bearish trend. We are clearly below the cloud. The cloud has clearly turned pink. Remember, we have to be back above that. If we're gonna kind of avoid a correction, we need to be back above the cloud when it gets to the pink, right? Because it's plotted 26 days. So, again, pullbacks bounce within weeks to new highs within weeks, and that's kind of what this covers. So we need to be back above by, early February. We need to be bouncing back above this cloud if we're going to avoid a correction. So let's take a look now at the Bollinger Bands and the Keltner channels. And you can see we are in the lowest quartile, though not below the band, but we're in the lowest quartile of an expanding bandwidth. The bandwidth is not outside of the Keltner channels. It's actually slightly inside of them. That's why we have the red dots, and you can see the momentum is bearish. And just for some context on that momentum, so we can kind of gauge how strong it can get. This is where we're at, and you can see, when you are, we can be a lot more bearish. In fact, the last intermediate decline, we got a lot more bearish than this, and the ones that we had during the correction got a lot more bearish than this. So it's bearish, but it can be more bearish. So I wouldn't say we're so oversold that we have to bounce. We got a new 4-week low point. The green line's hit 0, but we're still sitting around 100. We got to get the red line below 70 before we can get a good bullish. The nice thing about today, though, is we filled in the gap and we ended up closing above last week's high, which happened to be last Friday's last week's low, which happened to be the last period's low as well. So lower high, lower low, but we closed above the prior low. Now, that's a good sign. It's not bullish, but it's not bearish either because we closed at the high of the day. Very, very good sign there. The range was smaller than average, below that 65 points here. Let's look at it on this chart here. It was smaller than average, 6.4 versus 7.56. And you can see right about the average there too. So just slightly below average. It's actually pretty close. But that ATR is well above the 1% mark, and you can see the volume continuing to rise. So we're still kind of in a range where volatility and volumes, and for that matter also the VIX, has been rising. Now we pulled off the highs, so that's good, and we closed back below 20 after opening above 20. We closed back below 0.95% relative to the VIX 3M after opening above it. So good signs there, but we are still above 110 on the VVIX, which means we are still susceptible to a big jump in the VIX. Right? That's the big jumps in the VIX come out of nowhere, but when the conditions that make it ripe for them are when the VVIX, the volatility of the VIX, is above 110. Right now sitting at 110.94, and the VIX itself, again, well above that 15 mark, well above the 0.9, towards the upper end of neutral territory, but also well above its 200-day moving average, with all these averages rising. In fact, the 30 is about to cross above the 200. So again, that kind of gives you, that we're in this regime of rising volatility rather than peaking and then falling volatility. All right, now let's talk about what's driving this price action. As you can see, for the first time in a while, the top performing asset class, at least on this particular list, is the U.S. dollar, the ETF that tracks the U.S. dollar futures index. That's rare for the dollar to be the one that's up the most. Obviously, emerging markets are struggling, down 12%. Developed markets down almost 10. This is over the last 3 months, right? But if I were to just look at today alone and how we started off the week, remember we started off poorly, but then we rallied. The S&P rallied. The Q still finished negative. IWM finished positive as well as the S&P 500. Commodities rallied up pretty strongly. Yields were up slightly higher. If you take a look at yields, up to 4.8%, really moving higher, but again, really parabolic. Excuse me. If you look at the chart here on the DMI, like that ADX is rising pretty strongly, and you're almost below 10 on the negative. Like we're running up to the peak on 10-year yield of a parabolic move. The dollar's also there. We've already been above 40 for a long time, and you can see we've been below 10 for a while too. On the negative indicators, the dollar's been very strong. It's sitting up there at 110. Looking at the dollar relative to, like the euro, you're bordering on parity levels, and when you look at it relative to the yen, it's just so strong. Got the cluster, and it's a very, very strong pattern. But at some point in time, like that's going to run its course because it's so parabolic. It's hard to maintain parabolic moves, for too long an extended period of time. And the longer we do, because it can, the longer we do extend it, the more, the sharper the decline is once we do, in this case, the decline, the sharper the reversal is when you do start to reverse, whichever direction that happens to be in. Here, let's take a look at commodity prices, and they're looking really good, right? So they jumped up here the last couple of days. And if you look at crude oil is definitely, look at that 2-day move. We've had that MACD is stronger than it's been all last year. If you take a look at the 5-year chart, so there's the MACD right there, and you can kind of see my cursor. It is one of the stronger levels that we have. Again, we had a pretty good movement early 2022, but again, we kind of had this at the end of 2021, beginning of 2022. We got above the 200-day moving average. We started to rally. Like this is a pretty strong move above the 200-day that we haven't had here since that fall of 2023, when we had that intermediate decline that was so big that it was bordering on correction. And we got up to the 90s there, and we're in the 70s. If we get to the 90s again, then you're going to see rising inflation expectations, and that's going to have a significant negative impact on risk appetite, just like it did there, but probably even more so now because the Fed has been cutting rates, right? The Fed hadn't cut rates yet in 2023. In fact, in July, they had just finished raising rates. So much different scenario now from the FOMC standpoint, but also going to show like this is why yields are rising, is because inflation expectations are continuing to rise. The breadth still looks very poor when you look at the breadth for the market. Let's look at the McClellan oscillator. It did get back up above the minus 35 level, but you can see how far down it is. That's a deep drop. That typically is associated with corrections. When you get this low, below zero, and we're still negative, right? Even though if we're only at minus 28, we're still negative there. The number of stocks above their 50-day moving average is still pretty low. Let's take a look at that one here. You can see it'd be right here. Number of stocks above the 50-day moving average still at very, very low levels, below 100. The number of new highs are also still very low, abysmally low at 24. The average is down to 36. The number of new lows has been pretty strong, right? We had 286, I believe, on NYSE. Here, let me refresh this page. 213 according to this, but still a pretty decent number here, well above the 115 mark, right? Whenever that's that 4% mark that suggests, either an extreme that we can bounce off of, or the fact that we are just, in a much bigger, like this looks big right now in context, but if I zoom out to that 2022 correction, it doesn't look very big at all, right? I mean, it kind of goes to show that if we stay above, in fact, the average itself is almost up above that 115 mark, which kind of goes to show that, well, it is now. It's at 130. So it kind of goes to show that now the 20-day average has been above 4% new lows. That means, again, a new regime of that we are just significantly lower here. The number of stocks, that the ratio here is up to a high level. As I showed you, the number of stocks above the 50 are really low levels. We still haven't broken the 250 mark yet on the number of stocks above the 200-day moving average. We rebounded back up to 270. But here's the new highs and new lows index, clearly bearish, 600. And when you look at the New York Stock Exchange, clearly bearish breadth. Like it, and again, to only be down 5%. This is the worst breadth that we've had since that 2023 deep pullback bordering on correction, and then before that, an actual correction. We are the 20-day average is well below minus 100. It's bordering on minus 200. That's about where we got when we started. Things really started to get worse there in that fall. So, this is looking more and more like it's at that very least an actual intermediate decline. Even if we're not necessarily at that 5% number yet, it looks like that you could still qualify this as an intermediate decline, even if we never get there. Because remember, we were actually there this morning for the first time. We actually had a red box at the lows because we were past the 5% mark, but it doesn't stay there until the red type doesn't stay unless we close there. Hence why it's turned back to being orange and why it's back to 4%. So we'll see if by the end of this week we actually get it. We might not, but still, even if we don't get it, you could still qualify this as an actual, in my opinion, enough of a reset to qualify as an intermediate decline with the potential of moving. And if we did move up higher, that number could get really big, right? I don't know if it would get to 27%, because we kind of had something like that here where we just kept going up higher, even though we didn't necessarily get down. That was more of a convergence than anything. And again, that's what you see when you're on that MACD chart. But still, I think we're probably good enough to qualify that, especially with, as I mentioned, the breadth being as bad as it's been. The money flow is still down, not necessarily below 40, but still below 50. So still at relatively bearish levels here. We haven't really broken down hard yet on the actual money flow indicator below this particular low point, like we have on the price itself. So we're it's suggesting that we might actually be done here pretty soon with this decline. The money flow. Not all the other indicators are, especially the breadth indicators, but the money flow is suggesting that we might be done here sooner rather than later. All right, that brings us to our trade idea of the day. Let's take a look at Microsoft. Microsoft is our trade. You can see, obviously, it's been bearish. It doesn't have the red line yet on the market forecast chart here. Let's bring the market forecast chart up here. But the red line is just barely turned over for tomorrow. Dark pink shading, but your intermediate line is bearish. Your near-term line is already crossed above the intermediate line. So it has been bearish, but it looks like it's trying to find some support where there is some old layers of some old low points and similar spots. You can see the weekly chart is kind of flirting with the 200-week moving average. Last time it did. Last few times it did on the intraday basis, it ended up closing up above it. And then, the last time it actually did close below, we bounced up higher too. So we'll see if that ends up being the case this go around. Obviously, we have 3 red arrows on the stock. In the red line, you can see the stochastic, so it's barely red, and so is the MACD. If you look at the 2-line version of that chart, this is kind of something that really stands out to me, is we're sitting right on the point of control. Again, one big volume node here on the year, and this is it. And we're right smack dab going into earnings, right? Earnings coming after January expiration, going into February expiration. If you look at the DMI, I mean, these are all going to be somewhat bearish, but not strong enough to expect that we'll break that support. You can see the ADX there is in between 20 and 25. If you look at the RSI and the CCI, they're also at bearish levels, but not strongly bearish on either one of them. Kind of a bullish divergence forming on the CCI. And then looking at the Ichimoku cloud, sorry, wrong one. If you look at the Ichimoku cloud here, we are below the cloud slightly, and the cloud is just barely turning pink, and we have an intermediate strength trend, but again, and barely negative on the rate of change. But again, is that strong enough to break support when you're not breaking the lower band, you're not breaking the lower Keltner channel? The momentum is already pretty strong just to get to this point, and like I said, the point of control and that peaking. So what I decided to do here is try to take advantage of the higher volatility around the earnings and the fact that it may be peaking around this point of control, and sell a iron condor spread. So sell the low 20 deltas, 390 here, buy the 385, and then sell the low 20 here, 445, and buy the 450. That puts me about right there. And you can see my break evens for my break evens, again, going into earnings announcement, right? And we position size accordingly, right? We get our normal return, but with only 2/3 the risk. Because of that, and you can see I've got a lot of room to work both to the upside and the downside, which is probably the most concerning right now when we get to that earnings announcement, or again, with a big gravitational pull, because that's a tremendous volume node that we're sitting smack dab in the middle of right now. All right, well, that is it for today. You've heard from me now. Now I want to hear from you. Use that link popping out of the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.